So in today's episode, we're going to walk through what banks actually look at when they assess you, why your borrowing capacity isn't the same at every bank, the difference between what a bank will lend you and what's right for you, and how choosing the right lender can make a big difference to your options. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Hello, welcome back to First Home Unlocked. How are you today, Chris?
Doing well, Jack. How have you been, mate?
I'm really good, thanks, Chris. I'm really excited for today's episode, which is all about how banks actually decide what you can borrow. Because borrowing capacity isn't just about your income, and it's not the same at every bank. Banks are looking at your deposit, your debts, your spending, your credit history, and even the property you're buying to decide how much they're willing to lend you and how risky your loan looks to them. So in today's episode, we're going to walk through what banks actually look at when they assess you, why your borrowing capacity isn't the same at every bank, the difference between what a bank will lend you and what's right for you, and how choosing the right lender can make a big difference to your options. So let's start with what banks are actually looking at when they assess you as a first home buyer. Now, when a bank is assessing your loan, they're not just asking, can you afford a mortgage? They're also asking, how risky is this loan for us? And they answer that by looking at a few key areas together. Now, the first is income, which is the biggest driver of your borrowing capacity. But it's not just how much you earn. Banks also care about how stable and reliable that income is. So two people earning the same amount can get very different outcomes depending on how long they've been in the role, whether it's base salary, overtime, bonuses, or self-employed income, and then how consistent that income's been over time. Now, banks also need to verify your income, and what they ask for depends on how you earn it and which lender you're working with. Now, for most PAYG employees, that usually means providing your last two pay slips and sometimes an employment contract if the role is new or you're on probation. Now, if your income includes overtime or bonuses, banks often want to see a longer history before they'll count it. And it's common for lenders to shade that income as well, which means they might only factor in 80% of it to allow for that future variation, even if you've been earning it consistently. Now, for casual contract or self-employed buyers, the rules can be stricter. Banks are generally looking for consistency over time, and the way they assess that can vary a lot between the lenders as well. And this is also where timing matters. For example, if you've recently changed roles, switched industries, or moved from PAYG to self-employed, that can temporarily reduce how much a bank is willing to lend, even if your income is strong on paper. But different banks have different policies, so it's still worth speaking to us to see what options you have and start making a plan today. And we'll dive into how banks look at different income types in more detail in an upcoming episode. But for now, Chris, is there anything else first home buyers should know about how their income gets assessed?
Basically, you've got two options in life. You can increase your income, and that can you can save more and cut your spending and try to build wealth that way. Or you can look at your income as sort of a tool to allow you to borrow money as well. And I think a lot of people, if you start to think about that as well, you can go, well, if I increase my income $10,000, for example, that might allow me to, borrow an extra $50,000, which might allow me to buy a better property, etc. So you've got to sort of look at your income in two ways. One, yes, obviously gives you more money to spend and save, and obviously, try to increase your income over time, but obviously it also gives you more options. So you're trying to deeply understand your borrowing capacity is well worth your time and investment in just trying to understand now, because it's a great sort of skill and understanding, not just now, but in the years ahead.
Yes, it is important to understand your borrowing capacity because then you can use it as a tool, but you're not alone in doing that. You can come and book in a chat with us. We can help you break down the figures, understand what policies you can leverage to maximize your borrowing capacity and really explain that in detail. Yes, your online calculators will give you a rough guide, but we can do that work for you and then come and explain it all to break it down very clearly for you so you really understand your borrowing capacity and what's going to work for your situation and buying your first home. Now, the next thing that banks look at is your deposit. Now, your deposit size doesn't directly change how much a bank will lend you in the same way that your income does, but it does affect how the banks see the risk on your loan, and in some cases, whether they'll lend to you at all. Now, if you're using pathways like the 5% deposit scheme or LMI waivers, the source of your savings, and how long you've held your deposit can matter to the lender as well. Now, this is where genuine savings comes in. Now, genuine savings usually means money you've saved yourself and held for around 3 months, showing the bank that you can save consistently. Now, that 3-month time frame is pretty standard across the industry. And it's important if you're using the first home 5% deposit scheme, where that 5% has to be genuinely saved. Now, like I said, genuine savings usually means money you've saved yourself in a bank account. But most lenders will also count your rental payments as genuine savings if you've been renting consistently. And some lenders will accept your first home super saver contributions too, depending on their individual policies. But not all buyers need genuine savings in every situation. For example, if you're buying with an LVR under 80% or using a family guarantor loan, you don't have to meet the genuine savings rules. Now, Chris, what should first home buyers do if they've been gifted money from family? How do banks look at that?
Look, banks know that the Bank of Mum and Dad are one of the biggest lenders in Australia. And so it's not something that they're going to look at and go, oh, we're not going to lend to you because we know you haven't saved that deposit. Sometimes, with genuine savings rules, they are going to want to see that money's there for a little bit and make sure you don't spend it, etc. But, definitely don't be saying no to mum and dad if they're willing to give you some cash for a first deposit, particularly if they can afford to do so. So just be conscious of that and speak to your broker around sort of how long it might need to be in your account. But as you mentioned here, Jack, a lot of schemes don't even require that. And it may not even mean that you can't take action today because you already had genuine savings because you were, saving, you were paying rent and all these other things, etc. So you're getting some good clarity around that makes sense.
And like you mentioned, Chris, it's about coming and getting clarity because there's different ways that we can show genuine savings. So you don't want to be holding back on buying your first home because you think your savings has to sit in your bank account for another couple of months, for example, when you could have been using your rental payments to tick that box. So come and book in a chat and we can get that clarity on what works for your situation. And also, just to add to that, if you are using the 5% deposit scheme, that 5% of the purchase price needs to have been held in the bank account for at least 3 months. So if you have been gifted that money, you'll need to hold it for 3 months before the bank will consider it genuine savings. But as we've mentioned, most lenders will also consider what you've paid in rent over a 12-month period. So if your rental payments add up to that 5% of the purchase price, the lender can use that to tick off the genuine savings requirement. Now, in this case, you still need a 5% deposit under the scheme rules, but it doesn't matter if that's been gifted to you or held in your account for less than 3 months, as long as you've met that requirement another way. And one tip that I have for you if you are building a deposit is to use a separate savings account. Now, it makes it easier to prove to the bank that you've been saving consistently and held the funds for 3 months. Otherwise, if you're mixing in with everyday spending or moving money around, lenders might need extra bank statements to follow that trail, and it just slows things down when you get into the application process. Now, next up, let's talk through liabilities. Now, when banks look at liabilities, they're looking at things like personal loans, car loans, HECS or help debt, credit cards, or buy now and pay later accounts. And any of these debts are going to reduce your borrowing capacity. Now, when they assess credit cards, they look at the limit, not what you owe on the card. And borrowing capacity is generally reduced by about 5 times your credit card limit. So even if you pay off your card every month, a $10,000 limit can reduce your borrowing capacity by around $50,000. Now, why they take that limit is because that's credit you've already been approved to use. So you could potentially go out and spend up to that limit tomorrow. So they factor in the worst case scenario. Now, Chris, do you see a lot of first home buyers closing credit cards before they go through formal approval with a bank?
Absolutely. I think this is one of the things that a lot of first-time buyers just don't understand. I mean, why would you, right? Like if you think I've got a credit card limit, I just never use it, you wouldn't think that it would affect you. But a bank always knows that, if you do sort of take out a mortgage, you could potentially spend that money at any point. And so, just to protect themselves and you, they sort of often a lot of first-time buyers will reduce those limits because borrowing capacity is really tight in 2026 and has been for the last few years compared to sort of back in 2013, where a lot of first-time buyers never wanted to borrow anywhere near the maximum a bank would lend them. And it was much easier to have, a credit card here and there or a car loan. But often, for a lot of first-time buyers, it's clearing the decks and the debt and reducing credit card limits, getting rid of car loans, sometimes getting rid of HECS, all these things just because that extra borrowing capacity would give them much better options for their first home.
And it's really interesting, Chris, doing something like closing your credit card as a first home buyer, how much of an impact that does have on your borrowing capacity. Now, another thing is when you're organizing your pre-approval, you don't have to close your credit card. We tell the lender that it will be closed when you purchase, and you will just need to close that credit card and provide a closure letter before the bank will give you that final approval after you purchase. Now, another debt that's starting to become more common is buy now, pay later services like Afterpay and ZipPay. Now, buy now, pay later didn't used to impact your credit file, but after some updated legislation, they now do. And banks treat them the same way they treat credit cards. So even if your limits are small and you're paying everything off on time, the bank still factors in your maximum approved limit because you could go out and max it out tomorrow. Now, if you've got multiple buy now, pay later accounts, it can reduce your borrowing capacity and raise questions with the lender due to the multiple open credit inquiries. Chris, what are you seeing with buy now, pay later?
I haven't seen too much of this, right? I think it's maybe not as common, but yeah, it's one of those things that you can easily affect your credit file on. Is that people think, oh, it doesn't matter, it's a $200 t-shirt, it's not going to make a big deal, but it's still on your credit file, right? And I think that's where I've seen the real issues back in the day, is that people would, miss payments and, and they didn't think it was a big deal, but it was still affecting their credit.
And you're right, Chris, it's really important to be making your repayments on time, no matter how big your debt is, because when you're not making repayments on time, that does raise concerns with the lender when you go to a pre-approval application or a formal approval application. So just really making sure that no matter how big that debt is, you're making your repayments on time. Now, the next liability is HECS or help debt, which is one that comes up a lot with first home buyers. Now, the way HECS actually impacts borrowing capacity comes down to the way it reduces your income. Because HECS repayments are withheld from your take-home pay, the banks reduce how much of your income they can assess, therefore reducing how much you can borrow. It's about income, not the debt size. So two people with the same salary pay the same amount of HECS, even if one owes $30,000 and the other owes $100,000. Now, the lenders are caring more about how much your HECS repayments reduce your take-home pay than the total size of the debt itself. Now, this is an area that's changing quickly with the banks. Over the last year, most of the major banks have updated their policies around the HECS debt, and we're seeing three main approaches to this. Now, the first is some banks will exclude your HECS repayments from their calculations if the debt will be fully paid off within the next 12 months. Now, others have set a threshold where they'll exclude HECS debts under a certain amount, like $20,000, for example. And some banks have removed HECS from their servicing calculators altogether. So the landscape is definitely shifting as banks respond to affordability pressures. Now, Chris, do you think we'll see more banks jump on board with these HECS changes?
Yeah, I mean, been around for a while, and banks are always looking for ways to, lend more money, right? There's times when, in COVID where absolutely they were risk off and they just wanted to make sure that they were going to be okay, and borrowers weren't getting themselves into a bit of a pickle. But banks make money through lending more money, right? And any innovation that they can sort of do, particularly around things like, changing HECS or, and lowering the serviceability buffers. Banks are really trying to find ways to lend more money. And, and I think it's also in Australians' interest often, because a lot of people in the market right now are people on, medium and higher incomes, and they're trying to find ways to help people who are getting disadvantaged by the system. And sometimes that's people who have gone down and, done the right thing and try to educate themselves. And yeah, they've invested in themselves first, and they've got this debt attached. They're getting a real disadvantage when they're looking to buy their first home, because it's, the HECS is making them afford a lot less. So yeah, I do think this is one of the innovations the bank are going to push for, together with, say, longer loans.
It's going to be very interesting to watch this space, Chris, to see what innovations the banks come up with around HECS policy, the longer loan terms like you mentioned, and what they come up with in the future as well. Now, often we do get asked if it's worth paying off your HECS to boost your borrowing capacity, and it really does depend on your situation. Now, often that cash is better kept as a buffer in your offset account, or saved for emergencies, or used to increase your deposit. But sometimes strategically paying down part or all of your HECS can unlock more borrowing power. For example, let's say you've got a $25,000 HECS balance, and if you use $5,000 to bring it under $20,000, you could access one of those bank policies we mentioned earlier. And that might unlock enough extra borrowing capacity to help you access a better quality property or a location you couldn't reach otherwise. Now, this is where reaching out to us early makes a difference. We can run the numbers with you, compare what different lenders will offer you, and help you figure out whether paying down your HECS makes sense before you actually do anything. What do you think here, Chris? Is there anything else to add?
Yeah, I think HECS debt in the past was something that we often didn't talk to clients about just because the interest rates were so competitive, and you wouldn't really want to pay it off because it wasn't costing you a lot of money just to hold that debt compared to other types of debts like mortgages and credit cards, etc. And we didn't need to have those discussions because people could borrow enough for what they wanted to purchase. But it's a case by case basis, to be honest, Jack. You got to be really careful because you can't sort of then go re-borrow it if you change your mind. And so be really careful around it.
And you're right, Chris, it's really important because it's not something you can undo. So once you've paid part or all of your HECS debt down, it's not something you can take back. So that's where, like I mentioned, coming and speaking to us, we can run the numbers to see what it looks like if you do pay down part or all of your HECS debt and what that's going to mean for your first home purchase. So come book in a chat. There's a link in the show notes and we'd be happy to break down them figures and show you what it would look like before you actually take action on doing that. Now, next, the banks are looking at your living expenses to make sure you can actually afford the repayments. Now, banks don't just take your word for what you spend each month. They use benchmark figures called Household Expenditure Measure or HEM expenses, which are based on your household size. So they take into how many dependents you have and also your income. So if your declared expenses are lower than the HEM benchmark, the bank will usually ignore your estimates and use the higher number anyway. But if your actual expenses are higher than HEM, the bank will use your higher number, which can reduce your borrowing capacity. Now, common expenses that push people above HEM include things like private school fees and private health insurance. And lenders also factor in a 3% assessment buffer to stress test whether you could still afford the loan if rates increased. But it's still really important to understand your own expenses, not just rely on what the bank assumes through HEM. Now, knowing what you actually spend and can comfortably afford in repayments is what helps you choose a property that fits your real life budget, not just what the bank will approve you for. Now, let's talk about what banks are actually looking at on your statements when they are assessing your borrowing capacity. Now, for most applications, lenders will only require bank statements for your savings accounts. This goes back to that genuine savings requirement and proof of deposit that we mentioned earlier. But there are situations where they might need more. For example, if you had your genuine savings in separate accounts or across multiple accounts, they'll need to provide that trail. Or if you're relying on rental repayments as genuine savings, the lender will usually want to see a rental agreement and sometimes bank statements showing them rental transfers. And if the lender is looking through your bank statements, they may ask questions about things like regular spending on gambling, adult entertainment, or large cash movements. Now, with the bank reviewing your application, they can only see the statements you provide to them. So one simple strategy is to keep your day-to-day spending at a separate bank from where your savings sit. That way, when the bank reviews your statements, they're seeing clean savings patterns, consistent transfers, and your rental payments, and not every coffee or weekend purchase. It just keeps things clean, it makes the application process smoother, and it means the banks aren't asking any unnecessary questions. Now, Chris, anything else buyers should know about what lenders are looking in terms of expenses or bank statements?
Look, I do think you're right here, Jack, is some banks will look at this. Some banks have very strict rules around, and they put overlay sort of checkers on bank statements. And if they see anything that they don't like, particularly around things like you mentioned around gambling or, cash withdrawals, etc., it can sort of catch you out. It doesn't mean that one cash withdrawal is going to mean you can't borrow money or something like that. But you do need to be careful at some lenders. It's usually there's other lenders that probably wouldn't be looking at that and you're probably going to be okay. But, what you want to do is just make sure you're credit worthy and you're in a really good credit position to borrow money. And often, like you say, Jack, is we say, do your day-to-day sort of spending at a bank you're unlikely to use, for a loan. And then you just basically transfer your savings into a different bank and you got a really clear sort of statement you can provide to the bank around where your savings is. But also some banks will want to see where your income hits as well. And so you might want to have your income also in the bank account where your savings are and transfer to a different account that you do your day-to-day spending and have a regular transfer to that. So yeah, it's not like a must do. But if you are just sort of, some banks, that particularly on higher risk loans, like 95%, or when you're paying lenders mortgage insurance, some banks will look at your bank statements in a lot more detail than others.
And it is really important to set up your banking system, like you said, Chris, in the right way from the beginning. It just helps the application process go a lot smoother when you are buying your first home. Now, banks will also look at your credit history and run a credit report on all applicants when you apply for a loan. Now, credit in Australia doesn't work the way most people think it does. Banks aren't rewarding you for having lots of credit. They're mostly looking for signs of risk. So they're paying close attention to things like missed or late repayments, defaults on things like phones, utilities, or personal loans, or lots of recent credit applications in a short period of time. Now, this doesn't directly impact how much the bank will lend you, but if there are red flags in your credit history, the bank may not lend to you at all for a period of time. And depending on the issue, you might need to wait 6 months or more to rebuild a clear credit history before applying again. For example, one missed repayment because an auto transfer didn't go through can usually be explained and worked through with the lenders. But if you have multiple missed repayments in a row, that can delay a home loan application for 6 months or more while you rebuild that credit file. Now, one really common misconception we hear is I need to take out credit to build my credit score. Now, in reality, Australian banks don't work like that. They care a lot more about having a clean credit history with no missed repayments than having lots of accounts open. Chris, do you think there's a bit of a misconception around how credit scores work in Australia?
Yeah, and I think that sometimes that creates a little bit of overconfidence as well, so people will, they go, I have to take out more debt because I need a credit score. Then years down the line, they're like, well, that wasn't actually really helping me taking out those credit cards or, car loans, etc. And so that's an issue. But also the other way, sometimes people don't also, like America, they really protect their credit score. They know it's so important. They really focus on it and know the number. Australians just don't know their credit score. They don't know how it looks, and they often have never run a credit report on themselves. And so they sometimes make mistakes thinking, an overdrawn account or missing a payment or, for example, maybe even things like, phone bills and stuff like that. Sometimes they just make some, just housekeeping and they self-sabotage themselves, and that's really affected their credit score. And they come and apply for a loan and they're ready to sort of buy their first home. We're like, hang on a sec, did you just maybe not pay your credit card for a few months in a row? And they're like, yeah, but I have paid it off now. Well, yeah, your credit score is kind of fried now for the next 12 months. And so it's often those ones that just, didn't really prioritize just paying it off each month, didn't think it was a big deal. And then, just was sort of a bit overconfident on their finances and have been burnt because their credit card's been smashed. Not because they're not great at managing money, just because they didn't think it was a big deal.
And if you are still unsure about how credit scores work in Australia, or you want to know more, we will cover credit scores and how they work in Australia in more detail in an upcoming episode. So stay tuned for that one. And finally, banks don't just assess you, they assess the property you're buying as well. There are some situations where you can have a strong income, a solid deposit, no credit history issues, and still be declined if the property itself doesn't meet the bank's rules. So what this is every lender has what's called a security policy. Now, that's basically their internal rules around what types of property they're comfortable lending against. Now, some common examples include restrictions on very small apartments, often under 40 square meters, high density developments with lots of identical stock, especially if the bank is already lending to others in that building, or rural or large acreage properties where it can be harder to resell. So even if you are pre-approved to a certain amount, the bank still needs to be happy with that specific property you purchase. Now, this isn't something that comes up often, but it's why we have a process in place to check properties before we submit a formal approval application. What we do is we send the address to your preferred lender up front to make sure there aren't any issues with their security policy. If it's all clear, we can move forward with a formal approval application. But if there's an issue, we can quickly pivot to another lender that does accept that property. Chris, is there anything to add here on bank security policies?
Look, I think they're pretty safe if you're going down the housing market, potentially even the townhouse market. But, if you are going into sort of high density apartments, particularly ones that are built over the last 20, 25 years in areas where there's lots of apartments, you've got to be really careful. Or you're going for a very unique property like a big acreage or a big piece of land somewhere, or something or a really tiny apartment, etc. So just definitely be a bit careful because, and speak to your broker. Look, if they sort of say, look, the type of property you're buying is not going to be any issues, then you don't need to go check. But it's also highlights. If a bank doesn't want to lend, and is worried about this type of property, don't then push on and think that that's really the right type of property you want to buy. Like, don't go, I love this. It's really a red flag. I mean, we were warning about this all the way back in sort of that 2015 boom, and banks were pulling out of high density apartments, for example, then if you look at the best, the worst performing assets over the last sort of 10 years is those high density apartments. And so don't, sort of ignore that risk. And if a bank doesn't want to lend on this type of property, that's really sort of telling to say, maybe I should start looking at a different type of property.
So as we've discussed, when a bank decides what you can borrow, they're never just looking at one thing. Your income is one of the biggest drivers of how much you can borrow, but the banks also consider your deposits, your debts, your spending, your family situation, credit behavior, and the property itself, which are all layered together. And that's why two people with similar numbers can get very different answers. Now, just because a bank is willing to lend you a certain amount doesn't mean that's the amount you should borrow. A very rough guide, banks might lend somewhere around 5 to 6 times your income. But that number doesn't take into account how you want to live, how comfortable repayments feel to you in your budget, what happens if rates rise, and how your income might change over time as well. Now, if your income includes things like bonuses, overtime, or commission, those should be stress tested in your budget and not just assumed. And if you're planning kids or you're having career changes or lifestyle shifts in the future, those need to be factored in as well. And this is where having a clear plan and understanding your budget matters more than the bank's numbers. Now, as a mortgage broker, our key role is understanding your goals and vision and then matching the best lender policy to your situation, which means understanding how different banks assess income types, deposits and genuine savings, liabilities and expenses, your credit history, and the property you're purchasing itself. And then matching your specific situation to the lender who puts you in the best position now and into the future. Now, once we've understood the borrowing capacity options, we'll look at rates, but also just as important is considering what you actually need from the loan and the lender. For example, what are the turnaround times to get an answer? This is important if there's a short time frame that you're working with. Do you need multiple offset accounts to help manage your cash flow? What's the bank's onboarding process and user experience like for a new customer? So again, speaking to a broker early makes such a big difference. When you talk to us early, we can spot issues up front, clean things up like credit limits, plan timing around income changes or life events, avoid unnecessary delays, and make sure you're matched to the right lender from the start, not just the cheapest one. And down the track, we also review your loan regularly to make sure you're not paying a loyalty tax and that your loan stays competitive as your life and the market changes. Now, Chris, do you have any final thoughts on how banks decide what you can borrow or choosing the right bank?
Look, we covered a lot, Jack, but the final thing is just sort of make a point on is that if you're thinking about something, just ask the question. You're better off asking the question now than after and going, how did that affect my capacity? It's like, well, how would this affect my capacity? And then you can make a sort of an understanding of whether that's still a good decision, because sometimes, switching jobs isn't a good idea. Sometimes, taking on that sort of home, that car loan wasn't a good idea. It's hard to get rid of the car loan when you just purchased the car. And so ask the question up front. A good broker will happily just give you a quick answer back, and then you can make a decision after that. But, we've seen some crazy decisions of people not having kids because they thought they couldn't, buy a property if they have a child, which is absolutely not the case. They think, no, I can't borrow if I'm on maternity leave or parental leave, etc. So, ask the question, and you might find that the answer is not a big deal, or it's something you want to stop doing.
And if you do have any questions, you can book in a get to know you chat with us using the link in the show notes. And we'd love to help out and work out what's best for your situation. Because as we've covered today, income is the biggest driver of your borrowing capacity, but your deposit, your debts, your dependents, your spending, your credit behavior, and the property itself all factor in as well. And that's where having the right support early really matters, not just to get approved, but to choose the right lender for your situation at the right time for the right property in a way that actually supports your life and your future plans. Thank you so much for listening, and we'll see you on the next episode of First Home Unlocked. Thanks, Chris.
Look forward to it. Thanks, Jack.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.